It's ridiculous how much capital gains tax you can pay when you sell real estate. I'm going to show you 4 ways to reduce and even avoid capital gains in 2021. You can't realize the full profit of owning real estate until you sell it and take a profit. And you can't take a profit without paying a whole lot of money in taxes, right? Well, not exactly. Let's say you purchase a property for $100,000. Then you hold it for several years. It grows in value, and over time you sell it for $500,000. Your $400,000 gain is not taxed at the ordinary income tax rate. It's taxed at the capital gains rate, which historically gives favored tax treatment to people who make investments in such things as businesses or real estate. But under the new proposed system, the Biden proposal, if you have a $400,000 gain and you have over $1 million in total income for the year, you're not going to be taxed at the 15 or even 20% capital gains rate, but rather 39.6%, the ordinary income tax rate. That's going to generate about $158,000 in tax, or about $100,000 more than under the current system. This is a plan that's a proposal. It's proposed to take effect in 2022. Congress may pass it, Congress may not. But since the Senate is currently made up of 50 Democrats and 50 Republicans, with the Vice President holding the swing vote, you can be the judge of how this thing may go. There are some who fear that the real danger is Congress can get aggressive on this and not only make it effective in 2022, but retroactively make it effective back to January 1st of 2021, meaning anything you sell this year could be subject to the new tax rates. However, the more we get into the year and the further we get into the calendar, I think the less the likelihood that Congress would take such a strong position and make the tax change retroactive to 2021. So all this being said, the first strategy is to go ahead, sell now, sell it in 2021, pay the capital gains tax, and not defer the sale to 2022 when the tax rates could double. Strategy 2 is to go ahead and sell the property now in 2021, but don't take the cash out of the sale. Instead, exchange the proceeds from the sale of the property into another investment property in what's called a 1031 exchange. So when you sell an investment property and you exchange the proceeds into another investment property, you basically defer the gain or the taxable nature of that sale until some future year. It's a timing strategy. So what is a 1031 exchange exactly? Well, first, you choose a qualified intermediary who holds the funds from the sale of the first property and takes those funds and exchanges them into the second property, which must be of equal or greater value. Now, it doesn't have to be the same type of investment property. You can take an investment from an apartment house and invest it into a commercial office building. You then transfer the funds from the sale of the property through the qualified intermediary into the second property. The qualified intermediary holds the funds in the meantime. So how much time do you have? Well, you have 45 days to identify the new property. Within 180 days, close on the new property. And then the final step of the process is the replacement, or the second property, is transferred to you through the qualified intermediary, so now it is in your name. Now, so far we've talked about 2 strategies to help you reduce capital gains if you go ahead and sell the property in 2021. But there's a couple of other strategies you could choose to use which will avoid capital gains altogether. One of them is to convert your rental property or your investment property into your primary residence. If you convert it into your primary residence and then you wait 2 years before you sell it, you'll qualify for the primary residence exemption. If you're a single taxpayer and the gain on your primary residence sale a couple years from now is less than $250,000, if you're a married taxpayer and the gain is $500,000 or less, you'll be exempt from the capital gain. This does not, however, account for depreciation recapture, which is a whole nother subject and which would cover the depreciation you took on the property back when it was an investment. So you will avoid capital gains tax, but you will still have other tax as a consequence associated with depreciation recapture. The fourth way of avoiding is simply to not sell, hold the property, and let your heirs inherit it when you pass. This fourth strategy not only allows you to avoid capital gains tax, but it will lower the tax ultimately that your heirs will pay on the property. Currently, they receive a stepped up basis, meaning if you have currently a $500,000 property and you pass and your heirs inherit that property, they inherit it at the current $500,000 value, not the $100,000 value at which you first acquired the property. Now, this too may change under the Biden tax proposal, but for now it's a strategy that you may choose to employ at least to avoid capital gains tax this year. So there's 4 ways to reduce or even avoid capital gains tax in 2021. If you have questions, please send them to me. I'll do my best to provide you the answers or point you in the right direction. If you like this video, please subscribe it. Hit the subscribe button. Also click the thumbs up button. Please remember, if you know someone who's behind with the IRS, we can help them to resolve their tax problem and even settle for less than what they owe. Ending IRS stress, getting a fresh start. I'm Jim Flaus. That's it for this time. Until next time, so long.